Good evening, everybody, from a reawakening Lower Manhattan. My name is Paul Burkett, and every week I take 10 minutes to connect the dots for what's happening in the credit markets, the real estate world, and the distressed debt world. Automation Finance is a non-performing and distressed debt fund. We manage about $200 million, and it's been another very interesting week as the economy starts to start. We're going to talk a little bit about the improvement in the virus numbers, a little bit about the disimprovement in the employment numbers, talk a bit about the Fed and what that likely outlook is for inflation or deflation, a little bit about new housing starts or the lack thereof, and then I'll touch on what I think the world is going to look like post-COVID-19. So the good news on the health front is that the numbers seem to be getting better. These numbers from Johns Hopkins show the curve is improving just about everywhere, including in Brazil, which you'll remember from last week was looking much more worrying. That curve has really bent in the last 5 days. So good news indeed. Even in New York, we've seen the curve really bend over the last 2 weeks, and those numbers getting better all the time. And while I see everyone in the street still wearing masks, still wearing gloves, you can clearly see stores getting ready, taking boards off windows, cleaning their stores so that they can be open to start trading again. Still no sign of any restaurants, and no sign of a barber, but we hope that those guys will be open very soon. And that lack of new trade is really being reflected in the employment numbers. We'll see another very disappointing week where we were hoping to see these numbers starting to phase back down, but still 38.6 million people unemployed. That's million people unemployed. That's about 30% unemployment, and our model suggests we'll get to about 35%. So just a vast stop in the economy from the supply side of labor. And one person's labor is another person's income, and so the cycle begins. And so that's going to be very slow to come back, I think. Kind of reminds me, in the late 90s, I was living in London, and the subway went on strike. And the only way to get around London is really by subway. And it was an amazing and torturous period because for 7 or 8 weeks, everyone had to find different ways of getting to work. And certainly what happened to me, I think we'll find happening to others, which is I used to have to travel from the bottom left-hand corner of London all the way across almost to the Tower of London to where I was working at the time. And there was a direct line there by train, or at least I thought it was a direct line by train, until I was not able to take that train anymore and had to use a bus. Turned out the bus was much more convenient to take than the train. So my knee-jerk reaction of always taking that train was challenged by the fact that the train wasn't there anymore. And after the tube strike stopped, I never went back on that train, or at least very rarely. And I tell you that story because I think that's what we're going to find right here. We used to have 2 accountants. Well, now we just have 1 because we found an outsourced vendor who can do a lot of the invoice processing. We used to have several people in foreclosure oversight. Well, now we're just going to have 2 people in foreclosure oversight, and one of them wants to work from home indefinitely, and I think that's going to be just fine by me. So we may need less office space. So can I spend less than the enormous amount we spend on rent every month, and maybe get a slightly smaller unit? So today I looked at smaller offices in the same building. And I think a lot of other businesses are bound to be doing the same thing. So a lot of those people who sadly are unemployed right now will either not be coming back to jobs or will come back to very different jobs when this whole thing is behind us. The Fed is fighting, doing everything that they possibly can. I mean, the balance sheet has just exploded. They've done more in 4 weeks than was done in 4 years at the last Great Recession. And the amount of cash being pumped into the economy, people are talking about inflation. I don't think we're going to see any inflation anytime soon. We can see here the velocity of money, which shows that although there's more and more cash coming into the economy in the form of debt, that is not translating into inflation. If anything, it's been deflationary. We've seen a huge expansion in the nominal money supply, but no corresponding increase in growth, as ever increasing amounts of debt are required to get everly modest recoveries from slowdowns. And so trying to fight a debt problem with more debt can only go on for so long, but that could go on for significantly longer, as we're seeing very little weakness, for example, in the dollar. And while gold is up, it's not up anything like the 6,000, 7,000, 8,000 kind of levels that some people were predicting from a bout of German post-World War II type hyperinflation and the Wehrmacht Republic. But we are seeing a lot of funds raising more funds. For example, NRZ, we follow them very closely. They've a lot of NPLs, the non-performing loans that we also invest in. They announced they'd raised $600 million this week. And you'll recall they were a seller of a big loan book 6 or 8 weeks ago, kind of equivalent size. So they've recovered from that very quickly. And raise money from Fortress and other related parties to go looking for deals. And $600 million in the current environment is a lot of dry powder. And this I took from a speech that Howard Marks gave from Oaktree. And while he doesn't make predictions, these numbers kind of speak for themselves. So I just drew the line there back from 2008 to the current day. And throughout that whole period of pain in 2008, we've already beaten it in terms of high yield bond defaults. We've seen 19 defaults in April. I don't have the numbers for May yet, but the prediction is between 15 and 25% of high yield will go into default. That's about $400 billion in total. And I think that will set the tone for a spike in bankruptcies, corporate and personal, but also a lot more non-performing paper that's going to come to market, and funds like ours will be interested in bidding on that. To move quickly to the housing market, you won't be surprised to see a huge fall in permits. People just have not been applying. I walk by the housing department here in New York every day, and normally as I come to work there's a line of 20 or 30 people with rolls of paper under their arm where they're going in to have building inspector reviews of construction work that they're doing, and it looks like there's literally nobody in that building right now. So I expect further weeks of falls in new permits. But today's permit is tomorrow's project, and eventually a new apartment block or a new home somewhere. So those clearly are not happening. There's a big supply constraint there. Similarly on the builder sentiment, we saw a low, although the low is not as low as it went in 2008, it was a very fast fall in terms of home buyer traffic, but also home builder confidence. While all their stock prices have recovered, there's still not people out buying loans, partially due, I think, to lack of availability of mortgage finance. Speaking of mortgage finance, Fannie and Freddie have announced that they'll be coming back to the market. They're getting ready by Director Calabria to come out of conservatorship and I assume go back into public market ownership. And we'll see how that plays out. They need to build their capital reserves and get ready for coming back to the markets. In other news on the mortgage front, we heard this week that while there's up to about 10 million loans now in forbearance, which is about 6% of the entire mortgage stock, about 60% of those people are actually paying. That said, there's still a lot of corporate debt that's struggling. Some banks have up to 22% of their book in forbearance, which is extraordinary when you think that these are not mortgages, these are just general lines of credit that businesses are using. So what are we doing? No change really since last week. We're sitting on a lot of cash. We're looking for deals. We're seeing some people re-entering the market, continuing to bid though very conservatively, because there's a significant risk that there could be another leg down in the market before we get back to recovery. Sure. I hope you find these updates helpful, and please do leave a comment, positive or negative. Please do ask if there's anything you want me to cover, any analysis you want me to do. Put a like, just hit the like button, or even better, share it with your own audience. Extra viewers help me find investors. It also helps me find banks that want to sell loans, because we are an active buyer. So thank you, have a great weekend, and I'll speak to you again next week.